Welcome to EXP's Express Notes. Today we're going to talk about ACCA paper P4, Advanced Financial Management. Now P4 is a very broad paper discussing as it does the appropriate financial strategy that should be adopted by a business organization. It's a very technical paper in the sense that it requires a mastery of financial concepts and their application with lots of calculations. At the same time, it's a very discursive paper, since the candidate has to master a number of issues, conceptual issues regarding strategy, and to be able to articulate themes and concepts in words. Let's start in the broad context of financial management. Now, the actions and strategies and choices that management make, whether it's financial or otherwise, has to be done in the context of what shareholders and stakeholders in general expect from the company. So this is the orientation point. If we talk about the financial strategy of a company, it's clear that a CFO must select an appropriate financial strategy that is synchronized and in accordance with the overall corporate goals and objectives of the firm. In other words, the CFO can't go off and simply do what they would like to do with no reference to what the company as a whole is seeking to achieve. Having established that, let's look at the sorts of things that a CFO should be concerned about. One is the allocating, well, certainly sourcing and finding capital with which to fund the business, and to allocate that capital to appropriate investments and projects that the company may choose. We'll talk about investment appraisal, of course, as we go through the papers. This paper, it's a main theme. Of course, the CFO should be concerned with minimizing the cost of capital. That will help generate the highest returns to shareholders. Dividend policy, communications, internal planning, control, risk management, another core area of the syllabus, and of course maintaining proper professional and ethical standards in the company. That is an important theme and responsibility of the CFO, because the CFO is a leader and has to exert a leadership role within the business. Now, the business, of course, faces a number of risks. Now, business risks are very broadly defined here. It's the risks pertaining to the company's ability to generate cash flow, free cash flow for to its capital providers. So it's basically everything connected to the asset side of the balance sheet. That's perhaps a good way to look at it. It's really everything. It's the products, the markets, the acceptance by clients, the quality concerns, the efforts made to maintain reputation, the strategic choices made to penetrate new markets, to be able to run the business in an efficient manner, to be able to meet effectively and compete with rivals in the industry, to take into account and be able to ensure compliance with corporate governance standards, with political, with laws and regulations and environmental expectations. Very, very broad area. Do review and be sure that you're quite comfortable with the sorts of business risks that are mentioned here. Also, the risk management, as we mentioned before, is an area we're going to be spending more time on. It's focusing mainly on financial type risks. That would be interest rate and foreign exchange risk, and also, of course, risks connected to the use of debt in the company. We refer to this as financial leverage. Here's a bit of technical content with regard to diversification efforts by a company. Paper P4 deals with these issues in terms of portfolio diversification. You can see this is quite heavily mathematical, and using standard deviations and covariances and these sorts of things. So it's very important to spend enough time to get a handle on the technical side of the paper. Let's return briefly to the big picture with regard to stakeholder interests. Now, any experienced management will know that it's a challenge to be able to satisfy all stakeholder demands. In fact, it's impossible to meet all the demands, and therefore management has to pick and choose and prioritize and seek to reconcile the many claims that stakeholders have and expectations towards a company. In fact, stakeholder interests can conflict one with the other as well. One of the major themes running throughout management science in general is the problem of agency theory, and that is the problem that management will not act in the best interests of shareholders. There are ways in which this has been tackled by various authorities. One of which is, of course, introducing good corporate governance standards at companies to make sure that they are properly managed and that the managers themselves do not go too far off the track in terms of serving their own interests to the detriment of the shareholders. Stakeholder conflicts come in many forms. Of course, it should be assumed knowledge as to who the stakeholders are. It's a lengthy list, of course, and management can use such models as Mendelow's matrix to understand and to categorize stakeholder interest in the company and the level of influence that such stakeholders can exert. We also made reference to corporate governance, and in this paper we need to be aware of the main corporate governance models. Here's some features of what good corporate governance brings to a company, and this has been covered, of course, in other papers of the ACCA, so this is these are mutually reinforcing themes, and the candidate in paper P4 is expected to have a good, clear understanding of corporate governance in terms of its intent and also in terms of its implementation in companies. There are different corporate governance models that we need to take note of. Without going into great detail, there are the shareholder-based models, which would be typical of the US and the UK, even though when we make a distinction between the US and the UK, there are significant differences in those two shareholder-based models that are practiced on either side of the Atlantic. The US has Sarbanes-Oxley, which is the law, whereas in the UK, the Corporate Governance Code is what guides the behavior of major British corporations. If we look beyond the US and UK at continental Europe, then we have generally what is referred to as the European model, which is a more broadly based concern with stakeholder interests, which reflects in itself the greater degree of shareholdings by banks and institutions and industrial groups and so on. So the European model has a different background, heritage, legacy with regard to corporate governance issues, which is influenced by the structure of holdings. And finally, just so that we don't lose sight of this very important area, the impact of environmental and ethical issues. They are connected in the sense that concern for the environment and sustainability is itself an ethical sort of position to take, and therefore we need to be familiar with such things as the triple bottom line approach, which is concerned with measuring the performance of a company not only with regard to its financial bottom line, but also with regard to its social responsibilities and its responsibilities to the environment. So those are the three so-called bottom lines that the company seeks to measure itself by. And in annual reports, it is not untypical for companies now to report not only their financial statements, of course, and financial situation, but also to have a corporate social responsibility section in terms of how well they are doing against societal expectations, and a section on what the company is doing to reduce its carbon footprint in the world and to be environmentally friendly. Thank you. Next time we will move on to other issues also of a broad and concerning the global context which paper P4 is concerned with.